Hello and welcome. This is Jeff White, and we'd like to welcome you to our fourth quarter market outlook. Some of you joining us may be clients and others may not. Whatever the case may be, we hope you see value in the market viewpoints from our advisors here at Capital Strategies Group. As certified financial planner practitioners, we take an unbiased fiduciary approach to the way we help our clients, which is what we hope to share with you in our video today. This video is recorded in a way where we hope you feel the personalized, one-on-one approach we take with all our clients. Hopefully you feel like we are sitting down across the table from you having a conversation. I'm going to discuss 4 of the hottest topics I am hearing in the news and from clients right now. Again, I hope you find value in our perspectives and guidance. Many times we don't know when a recession starts or ends until many months after it's over, because a recession is defined as 2 consecutive quarters of contraction or a fall in gross domestic product. Therefore, we sometimes don't know there has been a recession until it's over. If we have a recession, or if we are now in a recession, most analysts expect it to be shallow and short-lived. This is in line with our expectation. And remember that the markets are not the economy, and the economy is not the markets. Markets are a leading indicator of an economic cycle, which means that the markets may have already adjusted and priced in a recession. There's still a few things hovering over the markets and keeping us from being in growth mode again. One is the prospect of interest rates remaining high for a prolonged period of time, which is likely. Rising energy prices and the political unrest we are seeing in the Middle East are also a bit of a drag on the markets. When the Fed raises interest rates, it's using one of the few tools it has to restrict the money supply, or in other words, to control growth in the economy. The goal of the Fed is steady and sustainable economic growth. When the economy is growing too fast, we have a risk of bubbles being created in parts of our economy, and that's what we all want to avoid. Higher interest rates discourage corporate and individual borrowers from purchasing large ticket items. Rates have been steadily increasing. They feel high because we have been in an extremely low interest rate environment for many years. By that comparison, they are high. We and most other financial professionals believe interest rates will remain high for at least a year. Have you noticed lately that what is good can seem bad and what is bad can be seen as good? For example, if we're in earnings reporting season and corporations are reporting strong profits and projecting good growth in the future, or if unemployment numbers when they come out are low, we would normally see that as a good thing. But right now, we fear good news because that means the Fed will take a more aggressive approach to slowing down the economy. And that the markets are a little bit fearful of that right now. So we are in this odd period of time when good is bad and bad is good, but we don't believe it will always be that way. Once the Fed is satisfied that high inflation concerns no longer exist, we believe we will return to a more normal state where good news is actually good news. So are more interest rate hikes expected? Our opinion is yes, at least 1 more quarter-point rate hike. Some economists believe 2 or 3 more, but our opinion is that we will see at least 1 more, and we believe the markets have probably already priced in at least 1 more rate hike. The Fed raises rates when economies are good and lowers rates when economies are bad. The fact that the Fed is raising rates tells us that the economy has been doing well enough that rate hikes are necessary. We don't believe there is any major risk or a market bubble like we experienced during the financial crisis. This is simply a restrictive monetary policy that is slowing the economy down for its own good. The fact that the Fed is raising rates tells us that the economy has been doing well enough that they've needed to slow it down. My wife regularly expresses her distaste of high prices. On more than one occasion, she has come home from the grocery store venting about the price she paid for eggs or a loaf of bread. With half a smile, I have to remind her that if our economy is healthy, prices will always be increasing because inflation is the natural outcome of having more money in circulation and population growth. It's simply supply and demand. She's quickly comforted when I suggest that our income generally increases also as a result of inflation, and we can afford the eggs and bread just fine. That's not to suggest that we should not be careful in our spending and consistent in our saving. Let's remember that part of the reason it's taken this long to curb inflation is because of the high levels of savings that people had after the pandemic as a result of a high rate of growth in wages. By our estimates, it's likely to be early 2026 before we see core inflation back to its 2% target. These things take time. There are a lot of moving parts in the economy: unemployment, wage growth, housing markets, and so forth. So in the meantime, it is good to watch your spending, keep a budget, start an emergency fund, make sure you are doing the essentials to set up for success. If you are prepared, you shouldn't need to worry. Acts of war are always difficult to watch, and certainly our hearts go out to all those affected by war of any kind. War is one of the many factors that can impact the markets. From a financial standpoint, to the extent the U.S. is able to keep its distance and not be involved would be seen as a good thing, and likely keep from impacting the markets too much. It's possible this news could cause some volatility, similar to what happened when the war in Ukraine first started. But we have been through dozens of geopolitical conflicts throughout the history of the markets, and markets have generally continued to weather the storm. If you work with us, we've planned for situations just like this. You can trust your investment plan. We routinely run different market scenarios to see how your portfolio stands up to the best and worst kinds of market turbulence. We are always aware of what's going on. If something ever warrants an adjustment to your portfolio, we will let you know. We are always aware of what's going on in the markets and the economy and major world events. Let your goals be the guide for your financial success. Your investments and rate of savings or withdrawals have been calculated based on your goals. The uncertainty of markets has been accounted for. The most impactful determinant in your success is whether you continue to follow your plan. And with that, we'll wrap up. Thank you for taking a few minutes with us, and let us know if you have any particular questions or concerns.